Hi, and welcome to class. We're covering Chapter 3, Financial Statements and Ratio Analysis. If I could have your attention, please. Okay. First thing we're going to talk about is the Stockholders Report. So the Stockholders Report, so if you own shares in a company, you're considered a stockholder, and you get this annual report. Sometimes it's just called annual report. That's going to be a summarization of the year's financial statements, the position of the company, financial ratios, and other metrics. But before you can file your shareholders report, it has to abide by certain rules. One, of course, is following GAAP, which we talked about last class. So it has to be within the official accounting language. It has to also adhere to Sarbanes-Oxley Act of 2002. And within the shareholders report, you'll get a letter to shareholders from the management expressing to you what we're trying to do as a company and how we're trying to move forward. So the four key elements of financial statements, number one, is going to be the income statement, which you are already familiar with, I'm sure. So the income statement is going to be a review of the company's income. So it's going to look at, as we saw previously, sales in relationship to expenses, operational, taxes, interest, things like this, to the bottom line of what are the earnings per share and what are the dividends per share. So to kind of summarize the income statement a little bit better, think about yourself. Think you're in a position where you want to start dating with the purpose of getting married to somebody, right? So the first thing you should do with that first date is ask to see their income statement. So you get a better idea of how they fit into your financial plan. So if somebody does not really have a very lucrative income statement, you may want to reconsider their choice for a future spouse in the marital relationship if they're really not bringing home the bacon. Because if you're looking for, an expensive lifestyle of high consumption and looking to have big houses and many bathrooms, this income statement on the first date, just seeing this quickly will help you to save you lots of money from countless other future dates it would take you to really find out the same information. So you really want to know how much is this person making, what are their monthly expenses, what are their taxes, and how much money is left over for you to spend once you're married in a shared account. So it could save you a lot of pain and headache in future dates, just knowing. And if they don't have an income statement on them, tell them you'll accept you could ask for their taxes or their W-2, W-4, or weekly wage statement. This, of course, is a income statement where we're looking at, very importantly, investors are concerned with revenues, sales or revenues. They want to see that they're increasing. So if you're in a growing market, like the simulation is in the automobile market, and that's growing double digits every year, there should be no reason for your sales not to increase every year. If your sales don't increase, that's a sign for investors not to buy your company. But they're also going to look at your gross profits. Are your gross profits increasing year over year? Are your costs of goods sold? How are they in relationship to your gross profits? How are changes in your selling expenses, your SG&A? So this is basically how you manage your office staff. How big is your office staff? How much are they getting paid? And looking at depreciation expense, we'll get to later. Getting our total operating expense as far as how much it costs to run the business, leaving us with our operating profits. So in the simulation, if you spend way too much in advertising, you're going to eat into your operational profits. So you want to be effective in your advertising. Don't create too much demand that you're not going to build enough cars for. So you may spend too much in advertising and then have a demand for an extra 500 cars you didn't build. So that goes to somebody else. So you always want to make sure that your advertising is meeting your forecasting and your demand needs. Otherwise, you're wasting operational profits. Then, of course, your interest expense. This can be controlled by paying down debt. So in some cases, when you're starting a company, you're taking on debt to grow the company to make investments. That's okay. So you you can expect new companies to have a growing interest expense. But once a company becomes later on in its life cycle, it can afford to pay down its interest and lower its interest. And taxes are, related to your profits and, of course, of your tax management. But at the end, shareholders and investors want to see what the earnings per share are, and by and large, if earnings per share go up, then stock price goes up. Okay, moving on to the balance sheet. So again, in a dating scenario for a spouse, you would want to see their balance sheet as well. For example, if you were on this date and maybe you're dating two people at the same time. Ever try that? Test it. Really, if you're such a good multitasker as many people claim to be, dating two people at once should not be a problem. So you're dating one person, right? So we'll just use you two as an example. You have the latest, newest car, the latest clothes. You got that very expensive $1,000 Canadian Goose jacket. You have your own apartment. So you're looking good, right? You live in your parents' basement. You have old clothes from high school. You don't own a coat, and you take the bus. Okay? So if I can't see your balance sheets, I don't know who's the better choice. So you give me your balance sheets, like everyone does when I ask. Okay, your balance sheet is terrible. You have $40,000 of credit card debt, $60,000 of student loan debt, a bank loan, and your car's about to be repossessed, and you're about to be kicked out of your apartment for not paying the rent. So you're a total mess, balance sheet-wise. Your balance sheet is fantastic. You have $300,000 in the savings account. You have $200,000 at the brokerage. You have a fully stacked IRA, 401k, and you have no debt. Everything you own is paid for. So now, even though looks could be deceiving, you're actually a more financially responsible person compared to the balance sheet. Your assets are much greater than your liabilities, where your liabilities are much higher than your assets. So by looking at you or looking at two companies, you might think this company is great. Look how great they look. Look at their products, how fancy their packaging is. They must be doing great. But until you look at that balance sheet, you might not know the other business might be a little dull, a little boring, not so flashy, but produces a lot of profits. So that's why we want to look at the income statement and the balance sheet to really see financially how a company is managing. Because you can't just go on appearances of the company, their headquarters, their products, because they could be days away from a bankruptcy. So in the balance sheet, of course, we're comparing current liabilities to current assets. We're comparing fixed assets and long-term debt, and we're looking at how much equity is in the company. So equity, think of equity as a percentage of the company you own. So if your company is owned 100% by you, you have 100% equity. If you have another shareholder who has who invested in your company, they have 20% ownership of your company, they're going to want to know is what is the equity to debt balance in the company? Meaning that if the company's assets are $1 million, how much of that is financed by liabilities and how much is financed by the money I gave you to, I contributed to the company. So if the company has $600 million in loans and $400 million that they raised through selling equity, stock, then basically they'd be 40% equity, 60% debt. So that's why we always want to look at the equity, because it's the amount of money you or your fellow investors have put into the company in relationship to debt and in relationship to the profits. So the balance sheet helps us sort that out. And this, of course, is an example balance sheet that we've experienced before, this class, obviously. And again, it's just a list of assets which should equal liabilities and equity together. That's how it balances. Now, a statement of retained earnings. So when you're a business and you make profits, you have two choices with those profits. You can either pay them as dividends or keep them and retain them in the business. So pay it out to your shareholders is one way to get rid of your profits, or keep the profits and they get retained in the business. So when you're running the simulation, your profits that you have from 1 year get rolled over to the next year for money you can spend. So if you're not, and there's no option to pay dividends in this simulation, so whatever money or profits your company makes, you get to reinvest in your business. So those are your retained earnings, and they accumulate. Even if you spend the retained earnings, they still accumulate in the equity section of the balance sheet. Because on one side you'll have the assets you used. If you never did anything with your retained earnings, you could have, $100 million in cash, $100 million in retained earnings. You see how that balances? Now you want to buy a $50 million building, so now it would be $50 million in cash, $50 million in building, $100 million in retained earnings. You make $20 million in profits the next year, you're going to have $120 million in retained earnings, $70 million in cash, $50 million in building. So it's just a record of the earnings the company has made and is keeping and investing into the company. So it's sort of like you start out with the retained earnings for the beginning of the year, and you add any profits that the company is going to keep, and that becomes your retained earnings balance at the end of the year. And this is an example of the retained earnings statement, and we're just looking at the retained earnings before, say January to December, and so net profits would add to it, but preferred stock and common stock dividends would take away from it. So dividends are the only things we take out of profits that don't go into retained earnings if we pay dividends. The fourth financial statement would be a statement of cash flow. So a statement of cash flow, again, is looking at where is the business might be confusing, and the income statement and balance sheet may not show a clear picture of what's happening to the money or cash of the company, but the statement of cash flow will. So the statement of cash flow is going to be a record of all the ins and outs of the cash of the company. And there are multiple sources of cash flow for the company. So one source, the most important source in my opinion, is from the business itself, from the operations or the operating activities of the company. So here we want to know, is the company throwing off cash? Is the company generating cash? So if a company generally sells a product at a price that will pay for all the costs and expenses of the business, then they'll have a leftover operating profit, and that would be going into the cash flow. So we would check the accounts in a year-over-year fashion to see the change in accounts receivable, inventories, payables, accruals, fixed assets, to get an idea of, is the money going into these assets or out of these assets, or is the money going into these liabilities or out of these liabilities? So when we compare the flows of cash into all of these balance sheet items, we get at the balance at the end, we'll get an idea whether or not there's been a net profit, the profit is turned to actual cash into the account. Because there are some non-cash charges, we'll talk about later, that affect your net profits. Your net profit may actually be lower than your cash because you're reducing your net profit due to some non-cash charges that help you to lower your taxes. So companies generally want to have a low net profit if it's going to help them reduce taxes. But the cash flow is going to be accurate. The cash flow is going to be the closest thing to the money that's going to wind up in your bank account, because whatever your net profits are, that does not necessarily mean that ends up in your bank account, where cash flow does. So you want to, especially cash flow from operations, because this is cash that you're generating from the business that you don't need to pay back. So it's the best source of cash, in my opinion, is that your business is generating profits in cash, and at the end of the operating period, you have a positive position in cash flow from operations. So that's the business I would want to buy. I want to buy a business that is already profitable. So if I went to look at a bagel store, and I wouldn't buy a bagel store if it didn't have positive cash flow, why bother? But if the bagel store had a positive cash flow of $20,000 a month, then I'd be interested in perhaps owning that business because it's throwing off a positive cash flow. It's generating, the money it's generating is exceeding their costs and expenses. Now, there could be cash flow from financing activities. This is the example we had before, where you had the apartment, the car, the nice clothes, the Gucci bag, the Katie and Goose jacket. That all came from a financing source. So that cash didn't come from operations like working a job it would be in the personal. Think of operating cash flow as like working a job and generating cash that you don't have to pay back. Financial cash flow could be borrowing money on credit cards, bank loans, student loans. This is money that the company is receiving as cash, but it's borrowed money and it has to be paid back. So in my opinion, it's not as valuable as money generated from operating the business. So as you know personally, you could live quite a long time on income you generate from a job, but you're just only going to live so long if you're trying to live off your credit cards or student loans, because that money is going to run out at some point. So that's sort of what we're looking at here is how are we increasing our liabilities or decreasing our liabilities, and what's the relationship to our equity. So we want to see that it's okay for companies to increase, and you might do this in the beginning of the simulation as a nexus point here. You might be issuing stock, issuing long-term debt, issuing short-term debt. So you're raising cash from financing activities to pay for new factories, to pay for operational investments because your company is new. And you, in the beginning of every company, you're going to borrow some money, raise some capital to get going, to get to an economy of scale, to compete with your competitors. Yeah. Okay. One additional thing is there's cash flow from investments. So it's not on the screen here, but there's an additional set of cash flow you could look at, which could be cash flow from investments. So if a company bought stock in another company, which does happen, if the company bought a piece of land or real estate and then later sold it, if the company invested in bonds. So if the company makes investments and then sell those investments and makes a profit, that would be considered cash flow from investments. Or if they spend money to buy an investment, that'd be a negative cash flow to purchase an investment. So a lot of times companies also will have, besides financing activities in operations, they'll also have investing activities where the company makes investments, maybe in other companies or other financial products, and later gets a cash flow when they sell them. All right. So there are also the notes in the financial statements. So at the end of the financial statements, there'll be specific notes, which are sort of like there are certain circumstances that in the financial statements that need further discussion or further explanation. So, for example, you may wonder why is this company's earnings per share jump from the revenues have not changed, but the earnings per share jump from $1 to $10 per share? How did that happen? You read the stockholders' notes, and you find that, oh, they won a lawsuit, and the lawsuit provided X amount of money to them. That was unexpected profit for the year from a lawsuit. So that's not likely to reoccur. So these are why you want to read the notes for any type of particular events that may occur, that may be unusual event may occur, such as, maybe there was a tsunami or a volcano that suppressed demand or weakened the ability for factory output, or something unusual may have happened that they might want to explain in the notes. Or they may in fact have changed the way they're accounting for something or want to bring your attention to something. So that's why the notes could be a really crucial aspect of the financial statements. And it's really the management talking directly to you to kind of explain some anomalies in the financial statements. Now, most successful companies operate internationally, where they'll have sales in international markets. So if you have a successful company and you think that can work overseas, you want to start setting up shop and exporting those ideas overseas before an overseas competitor comes in and fills the void that you've created for this new product or company. Now, you're going to have to consolidate these financial statements. So actually, it's interesting. We were just doing this in another class today. It's a financial analysis for the Excel class I teach. We were doing a case project on a company that had sales in Australian dollars, Canadian dollars, British pounds, and the European euro. So they had sales in these four markets, as well as U.S. dollars in the U.S. And the task of these students were to figure out the total profits from each of these areas and then consolidate them into one set of financial statements that were in dollar terms. So foreign exchanges had to be used to convert the foreign currencies into dollars so they could be added up, so they could say total wide world sales for this company was X billions of dollars. Because you can't add euros to dollars to pounds. You can't add that together because they're different currencies, they have to be translated, just like a language has to be translated, into a commonality, which in this case was dollars. So once you translated all the foreign currency money earned in sales back to dollars, then you could start to consolidate your financial statements. So FASB is another accounting regulatory board, and they have the Standard 52 that mandates how U.S. companies are going to translate their foreign currencies into U.S. dollars. So there's a particular way that they want you to translate that, because since the currencies change every minute of every day, they have to really set up a standard of how we're going to represent this on the financial statements. So the currency rate, or the translation method that a company uses, this is a technique. So companies have a little freedom or a little choice in here in the technique that they're going to use to translate their foreign currency denominated assets back into U.S. dollars. So the key thing here is that they want to keep it consistent the way they approach it, and generally the closer the exchange rate is to the end of the year that you're going to be translating all this money into, the more accurate it would be. But for a lot of companies, they may have an effort to, if they earn currency in foreign countries, they may want to, on a weekly basis, bring that back and translate that into dollars on a weekly basis, so that way they may have a bit of a more closer relationship between when they've earned the dollars and when the exchange rate is at the same time they're earning the dollars, rather than holding them all in a foreign bank account and then translating them at the end of the year. So it's really up to the company what method they want to utilize to manage their company and their financial statements. But it is something that companies have to think about. How are we going to consolidate? All right, so who is interested in financial ratios? That's first, let me explain why financial ratios. Financial statements in an annual report can be very long, multi-paged. Balance sheets and income statements can sometimes reach up to 20, 30 pages, depending on how complex the company is. And it's all very difficult to interpret and understand. And then to try to compare to another company is even more difficult. So unless you're a CPA, really going by the full financial statements is going to be a time-consuming and laborious task. It's much easier to go and review the financial statements. Review the financial ratios that you can create from the financial statements. So this is sort of like looking at your grades or grade point average to get a summation of how you did all the work you submitted, rather than having to sit and look and regrade all your work. So it's a shortcut into how well a company is doing, and since their ratios are comparable between different companies. So as annual reports, a lot of the key figures in the annual reports are not directly comparable company to company because of the size of the companies. Ratios make everything comparable. That proverbial taking, comparing oranges to apples, and this is converting everything to apples to be comparable. And then people who are going to look at these financial ratios, shareholders, creditors, management, are all going to be reviewing these financial ratios to see how well the company's doing. This is the same thing that's going to be happening in the simulation. The overview points are a year-over-year analysis of how your company is doing. So you get measured in two ways. How you're doing against your last year's results, sort of like you got B's last semester, you're getting A's this semester, so you're doing better. That's a year-over-year comparison. But then you're also going to want to compare how is your company's position in the financial ratios compared to everybody else. If I was interviewing a candidate for a job and they said, I have a 3.95 GPA, and I would be like, whoopity-doo, what's the average GPA for your university? Oh, it's 3.98. Oh, okay, so you're below average for your GPA. So that's what a lot of employers, if you're smart, you would want to know, what is the average GPA for that business program? If the average GPA is 3.0 and you have a 3.9, that's a good achievement. But if the average GPA is 3.5 and you have a 3.4, that's not such a great achievement. So you have to really look at the industry average to see, since a lot of schools have an extreme grade inflation, and everybody's running around with 3 5s and 3 7s, employers know that, to the point where they're so frustrated that they go right to testing your skills on the interview rather than believing whatever your GPA says about you, because they know it's been so wildly inflated. So now, especially if you're a computer programmer, you're going to get, they're going to ask you to actually program something, and they're going to see how you actually do, what your skills are. They don't really care so much about your GPA, because they know that, you know, by and large, a lot of students have good GPAs. But we're not interested in a lot of students. We're interested in the few that are going to be great employees. So now they resorted to actually testing your skills on the interviews, because companies are no longer just going to look at the one number. They can compare it to the whole average. And that's what the ratios are, the same thing. So you don't want to look at the financial ratios alone, because if you have a certain GPA in the not GPA, a certain gross profit margin in the simulation, you have a 30% profit margin, is that good or bad? You don't know until you find out that the average profit margin you start off with in the industry is 40%, so now you're below the average of the industry. And as each round goes, that average gets higher, so if you're not in line with that average or beating it, you're not doing so well. So you have to always compare these numbers to an industry numbers. So that's why we do this cross-sectional analysis. So we're going to look at different firms. We're going to take the year 2019, and we're going to look at the fast food company like we did in the spreadsheet, and we're going to look at how do they all do in this year compared to each other. And then we can tell which company has the strongest set of financial ratios compared to the other company. That's called a cross-sectional analysis, looking at multiple companies at the same point, developing an industry average to say, okay, is my company above or below the industry averages? Just like the example before, is your GPA above or below the College of Business GPA? So you might be running around thinking you have a great GPA, but what is it in relationship to the entire program? That's what tells you if you're above or below the average mark. Now, benchmarking is sort of another cross-sectional analysis, but you're going to compare those results to a key competitor. So, for example, in the fast food industry, you might benchmark yourself to McDonald's and say, this is our strongest key competitor. Are we above or below what they're doing? So a benchmark would be to, tie yourself to a key competitor. Not so much because if you have an industry, there's 20 companies, and 10 of them are just really horrible, the average is going to be skewed artificially lower. So you're going to maybe select the pool to the key competitors in a benchmarking scenario. And so here's an example of a couple industries. We have here a computer industry up here, and then we have a builder's material, which would be Lowe's and Home Depot. So you wouldn't want to compare computer manufacturer Apple to Home Depot. They're just too different. Just like you wouldn't want to compare a computer science major on this campus to a philosophy major. They're very different things. They're not comparable. You don't want to compare their GPAs or compare what their experiences or work capabilities are, because they're very different. But you would want to maybe you would want to compare a computer engineering student to a computer science student, because they're pretty close enough, so that could be a more comparable selection. So here, when we do these industry averages, we want to put companies in industries and then even file down even more into sectors. So so you might have the technology or the computer industry, and that could be software, hardware, firmware, different things like that. They're also looking at grocery stores, Whole Foods, of course, and then you have merchandisers like Walmart and Target. So you always want to be compared to what's closest to you in similarity as a company. So there are types of ratio comparisons. There's a time series. So this would look at how the ratios progressed over time. So in a simulation, you're going to have a time series from year 1 to year 6. And hopefully your profit margins are moving from 40% to 70, 80% by the end. So the time series shows an increase in revenues, an increase in operational and net profit margins and gross profit margins over time. So we really want to see what the performance, just like in your grades at the college here, hopefully you're starting off with B's and you're progressing and getting higher and higher to A's as you're getting the hang of college and you're moving through your discipline. That's a time series. And that's something that recruiters look for, whether it's a job or it's getting into another school after this. Did you know, the grade point average is one thing, a 3.0, but did you start at a 4.0 and end up at a 2.0 to get a 3.0 average? Or were you starting at a 2.0 and raise that to a 4.0? Still a 3.0 average, but you're on the upswing. You're yo-yoing up instead of yo-yoing down, as they say. So combined analysis could be a cross-sectional and time series. So you could look at a cross-sectional analysis of many companies and how everyone's doing through time. So if your competitors are advancing much quicker than you are, you might be doing fine and things are going up and you're progressing, but if your competitors are progressing faster through that time series, then that tells you something there too. You're really not escalating or moving as forward as fast as the competitors. And this is something that you should do in the simulation. There's an industry page in the simulation where you could go in and see how all your competitors are doing. In the practice rounds, you could look against other computer players. So if you're not doing well, how did they configure their cars? What were their features? What was their operational investments? What were their profit margins? So you can dissect, you can reverse engineer. Like sometimes ever take a test and you're not sure how to do the math problem, but you see the numbers and you see the multiple choice solutions, you can kind of reverse engineer the answer. You can do the same thing in a simulation. You know, so here's a look at, here's an industry average, I guess it's the airline industry, in comparison to American Airlines. So that way you can plot a chart to really see how is, you know, combining how your company's doing compared to the industry. And the airline industry is typically a very competitive and sometimes low margin industry because they're competing so heavily competition-wise. It's another one of these industries that it's sort of price first. You enter price first, price first. So when you go and you're looking to travel somewhere, maybe you want to go to Chicago, and you say, hey, Spirit Airlines has $90 each way, but Southwest has $135 each way. So you might book on Southwest. But you'd be surprised to find out that, hey, at the end of the day, I wound up spending more on on Spirit. Say you book with Spirit. I spent more in Spirit than I would have with Southwest because Spirit charges for bags. Spirit charges for what seat selection. Spirit charges for water on the plane. Spirit charges for everything. So they make the price low, so you want to go with that airline, but you get banged on all these extra charges. So if you go with someone like Southwest is famous for, your bags always, up to 2 bags, always fly free. Other airlines, you pay a price for their first bag, and you pay another price for your second bag. And some airlines, you have to pay for a carry-on. You know, you have to pay for food on the flight. You have to pay for headphones on the flight or entertainment on the flight, and other providers give all, that's all inclusive. So, but they've learned though, even though customers say, I'd like bags to be included, I'd like no hidden charges, it's still price first. Come in the room price first. So I want to see what the price is and then make my choice on that. And that's why a lot of prices, if you ever bought cable, right, there's this price on cable. You know, we're running special, $39 a month for internet. So you go and you get that $39 a month for internet, and it turns into $59 a month. Why? Oh, well, you need a router. We're going to give you that to you, but it's $20 a month for that, or you need this, or you need that. Same thing with like cell phones. You see that cell phone price, only $50 a month, but after taxes and this charge and that charge, it's $70 a month because they come in price first, because that's how they know consumers think. They look, low price attracts them, and they want to buy on that low price. But as a smart consumer or company, you want to step back and sort of add it up. Okay, if I do take Spirit, I need to carry on. I need a carry-on, I need a bag, and I'm going to expect this. What is the total price after everything I'm going to be buying? Because they're going to wait to the end to tell you that very big price right before book the trip. So along the way, they keep inching that price higher. So that's why airlines, you know, one of the reasons airlines are tough, because you have these discount carriers. And it used to be that Southwest was considered the most discounted carrier, but now you have Frontier and Spirit that come in price first even lower. And it's just a mind game they're playing with consumers, because they know they're giving you a price in a flight that's a loss for them. They're losing money to fly you at that price. You know, I think Frontier had $39 to Orlando each way. They're not making money on that. But if you don't want to sit at the last row next to the bathroom, you have to pay a higher price to get a decent seat. And if you want to take on bags or anything, that's how they eventually charge you up to a higher profit margin for them. But when you do the Skyscanner or Google Flight, and it lists all the airlines in order of charges, all the best affordable flights come up top, that's what you're selecting. But you don't know what the real hidden costs are. These are all kind of strategies companies use to increase their profitability, but not scare you away as a customer. The same thing with the auto industry as far as what we're talking about. Have you ever seen these incredible ads for a low lease price? Lease for only $69 a month. Lease this new Toyota Corolla, $99 a month. So you're like, I can afford that. You run down to the dealership, like, let's go. I want that $99 a month lease. Like, you got it, but you can only drive 5,000 miles a year, and there's a $5,000 sign-up bonus, a sign-up cost. Oh, okay. So I got to pay $5,000 to get the lease. I can only drive 6,000 miles, and then I can pay $100 a month. Yes. Well, nobody would want that. Well, that's the deal, and that's $99 a month. We could rework it, so if you want, only $1,000 down and 12,000 miles a month, then that's $299 a month or $199 a month. See how they get you in price first with this low lease, but then when they actually see the configuration of what you're trying to do, the price goes up a lot higher. These are just ways companies are trying to maintain their revenues, get people interested in buying their products, but also make the profits. And everybody wants to see those low prices. So this is why, I can't tell you, restaurants do this too, and it really annoys me when you go to a restaurant, and I was at Outback, and they're like, you're getting a steak, and like, oh, would you like sauteed onions with that? Would you like mushrooms with that? So in most decent restaurants, that's just adding would you like cheese on your burger or tomato? But they had an upcharge for getting those things. And even at Boston Market, the sides they have at Boston Market, there's regular sides, and there's, I don't know what they call it, but there's other sides that are premium sides that come with a higher charge. So when you get your half a chicken with two sides, if you're ordering the regular sides, fine, it's $7.99. But if you get the premium sides, now you're paying, $9.99 because there was an upcharge to get the, loaded baked potato or the sweet potato mash or whatever they. Again, they're trying to show the low price point on the entree or on the meal at the restaurant, but hiding these extra charges until it's rung up and you're sitting there with the meal in front of you, it's rung up, it's too late, you're just going to buy it and move on. And then if you complain, oh, there's a small sign right here that explains it, sir, did you not see this? Are you that dumb? So this is all because companies are hyper-focused on their financial ratios. So as an investor, there are a few cautions you have to worry about. If you see financial ratios that have changed a great deal year over year, that could be a possible problem. So if inventories have gone up a great deal, or accounts receivable, or accounts payable, any huge change that deviates from the norm, that might be something that could be a problem that you want explained at least or looked into. As an investor looking into a company, either to buy a stock in that company or to buy the company in total. A single ratio is not something to go crazy over, one ratio that's bad. So a single ratio does not prove enough significant information about the overall performance of the firm. So I might have students come crying at my office hours, my return on assets, my total asset turnover, I got 1 star, I can't get this up, crying. I'm like, yeah, but you're making 1 billion points in your first place in the simulation, who cares? You don't have to be perfect in every, it's not your report card at Stony Brook. You don't have to have A's in every class. You don't have to have 5 stars in every financial ratio. Sometimes you have to sacrifice a financial ratio to get better results in the other financial ratios. So if you're buying assets to enhance the company, that's a long-term strategy. It's going to pay off by year 6. But in the meantime, you may have struggle with your return on assets or total asset turnover while you're building a company. That's to be expected. You can't be an A in every category of your financial ratios. Just like in school, you might do similar calculations where maybe you're taking, one of these students are taking 7 classes, and one of the 7 classes is going to take up the same amount of time as the other 6, so you make the smart decision and say, let me just drop that class, or let me just I can't do all the work to get to A in that class because I'll fail the other 6 classes, so maybe I'll just do just enough to get a B in that class so I can get an A in the other 6 classes. You know, you would all face the scenario where you have to make choices. Like, there's just one class that's just really ridiculous, the amount of work and reading you have to do. And the other classes, if you did all that, you'd never make it to get the full grade in the other classes. So you have to prioritize where you're going to be spending your time and energy, just like companies will do also. So if all you care about is the financial ratios, and you're trying to get every financial ratio to shine, you may not be managing the company in the best way long term. Sometimes companies have to take a pause, build the company, spend their money on assets, and then become more powerful and stronger in the longer term. That's something Amazon did early on. They took on a lot of money, and they had terrible results in earnings and profits in the beginning, but they built themselves into a juggernaut because they had long-term goals, and they weren't worried about their short-term financial ratios. Now, when you're calculating the financial ratios, they should be, when you're comparing different companies, they should be as close in time as possible. Because if you had a company whose year end was November 2019, and the second company's year end is in January, you would want to look at January 2020 would be closest to December or November 2019. You wouldn't want to look at January 19 compared to November 2019. So sometimes you want the whichever closest in months, because some companies' year ends are in January, some are in March, some are in December. They can choose whatever they want for their year end. It doesn't have to be a calendar year end. So whatever it is, you want to really try to keep it as close to the same point in time as possible for comparisons. For example, I shouldn't compare how well you do as a Stony Brook student and your grade point average today to students from 20 years ago. Because things have changed. The courses have changed, the level of work has changed, the grade point average has changed. It's not really comparable. The whole school has changed. The faculty has changed. You can't compare you and your grade in a class or grade point average to a student from 20 years ago in the same program, you know, or compare your grade here to another school. So from another school from 10 years ago. See how they're less comparable? So the more similar the situation is in time and is in industry, the more comparable the financial ratios are. And of course, you would want these financial ratios to be audited by an accredited accounting firm. You would want them, hopefully the financial statements were following the same methodology. And then you would also want to worry about inflation. If you're doing a time series of financial ratios, you would want to adjust the results of the financial statements by inflation throughout time. So if you're doing a 10-year comparison, the revenues in 2010 compared to the revenues in 2020, they're two different numbers, but they actually might be the same level if you adjust for inflation. You know, that's why when you look at movies, if you look at the total box office for Snow White compared to the total box office for Avengers Endgame, they're very too far ends of the spectrum. But if you adjust Snow White for 80 years of inflation, it comes to a much higher box office total, and then it's more comparable to today's films. Okay. So here we have a nice, friendly Whole Foods. You're familiar with Whole Foods. It used to be their own independent company until Amazon came as a bigger fish and swallowed them up. So now they're Amazon. So when you go to Whole Foods, you could use, this is Synergy, you could use your Amazon Prime membership to get discounts at Whole Foods. So you show your barcode, Amazon Prime, and you get the sale. Sometimes you get an extra 10% off. Sometimes they'll throw in free delivery. So as this is common for companies to acquire other companies. So before Amazon acquired Whole Foods, you got to be sure they were looking at their financial statements and their financial ratios compared to their peers in the industry. So here's just an example, a balance sheet from 2016, 2015 for Whole Foods, and an income statement from 2016 and 2015. And this is in the millions. So what this means is you had to add a few extra zeros here to put this, like I think 6 extra zeros to count this in the millions. So this is really, it's not 15,000 of sales, it's more like 15 billion. We truncate financial statements in the thousands or the millions, so the numbers can be smaller, so they don't take up so much room. So it's easier to look at, easier to digest in this, displaying it in the millions. Okay, so moving into the first set of financial ratios, we're going to talk about liquidity ratios. So when we talk about liquidity, being liquid, it means having more current assets than current liabilities. So liquidity is looking at if you're liquid, that means you have an abundance of cash, and you have an abundance of current assets. You can easily afford things. So being liquid is a good thing. So the current ratio is just current assets divided by current liabilities, and it's a measure of, it's just a proportional measure of current liabilities and current assets. So we always want companies to have more current assets than current liabilities, because current liabilities have to be paid back quickly. And if you don't have enough cash to pay back these current liabilities, the company can be insolvent in some cases. The quick test, or the quick ratio, sometimes known as the acid test ratio, is just subtracting away, it's just, we typically in this, we want to take out the inventory. So, hold on a second. Yeah, we're going to talk about inventories in a second. But with the quick ratio, we want to not simply just divide. We're going to take the current assets. In this case, they're saying current assets minus current liabilities divided by current liabilities. So that would give us a different way of looking at a very similar ratio. It's just a different percentage to look at it. In some cases, they wanted to subtract out the inventory as the current asset, as from the pool of assets compared to the current liabilities, to get an idea of how strong the company is when they're not relying on their inventories, because inventories are considered the least liquid. So, inventories are an important, very important thing to most companies, because this is an area where inefficiency can be developed when we're looking at companies that are developing too large of an inventory. So, for example, in some terms that you're going to understand soon, if you expected to have a surplus of cash at the end of your simulation round when you're running your auto business, at the end of the round you have a deficit, and you're like, how is this possible? I saw in the pro forma financial statements I was expected to have a surplus, and now I have a deficit. I'm kind of mad. I'm going to go break down Professor Nugent's office door and figure out why the simulation is broken. First thing I'm going to do is look right on the production page and see, oh, you had all this unsold inventory. That inflated, unsold product that inflated your inventory, and since you didn't sell these products that you promised to sell in your forecasts, you didn't generate the profits they should have generated, and therefore you had this unexpected deficit. So you forecasted to sell 5,000 vehicles because you didn't look at the student user guide, but you only had demand for 2,000 vehicles. So 3,000 vehicles stayed in your inventory, and 3,000 vehicles weren't sold that you were forecasting, creating this unexpected deficit. So now as a car manufacturer or any manufacturer, you don't want to have old inventory laying around, because as soon as the new year model comes out, they're worth less. Just like when you have an iPhone, the new iPhones come out, your trade-in value of your old iPhone goes down significantly. So as the newer models come out, it devalues the current inventory of remaining models. That's why laptop manufacturers want to keep a very tight inventory. On laptop sellers like Best Buy want to keep a very tight inventory, because if a new processor is announced, that degrades the value. They generally lower the price of the old processors, which makes the older laptops prices have to go down. So if you bought a big amount of inventory at this high price, and now they're going to sell for $100 less because they're not the latest and greatest processor anymore, now you're taking a loss on your inventory at Best Buy. And that's why Best Buy, you'll see these discounts sometimes where they're trying to sell these laptops because they want to get rid of them before the value goes down even more. And that's why they'll say, like, if you want a new car, try to buy last year's model at the dealerships. If you go to the dealership and the 2021s are coming in and they have 5 2020s left on the lot, don't buy the new 2021 coming in. They're still brand new cars, never driven, but the one that's 1 year previous will be less money because, you know, the new model has come out with better features, you know, better styling maybe. So you always want to, it's very important to look at the inventories of a company, analyze how well they're managed in inventory. In fact, auto manufacturers are very good at managing inventories down to what they call just-in-time, where the inventory comes in just, you know, minutes before it needs to be manufactured. So if you look at a company like Apple, they rely on a lot of contract manufacturers. So everybody knows where the majority of iPhones are made, right? They're made in China, but not by Apple. They hire another company to manufacture the products who are specialists in manufacturing. So the company that manufactures iPhones manufactures other things as well. They're a company for hire, like a Flextronics is a similar type of company, which is a contract manufacturer. So Apple doesn't make the products with their own employees. They hire another company to make the products. That enables Apple to hold much less inventory because it's held at the manufacturer, not at Apple's. They pay when they're going to receive the final product. And then Apple has to be very accurate in their forecasts of how many are going to be built, how many they're going to hold in inventory, and what are going to be in the stores, because they don't want to wind up with an excess of unsold phones, because that's going to be bad for their financial statements and bad on their inventory ratios. So this brings us to our activity ratios. This is where we're looking mostly at the operations of a company, and we're interested in how effective are the operations of a company. Now, in the simulation you're running, your effectiveness, just being a little bit more effective than the next team, could make you a lot more earnings and get you much higher stock prices and much more overview points. So just being a little bit more accurate on your forecast, being a little bit more efficient in getting your profit margins up on your vehicles, just selling 100 more cars can make a big difference. And you'll see when we start reviewing the results of the simulation that we might have 70 companies, and they'll fan out from round 1 to round 6 by a great deal. And it's all small efficiencies that have made the big difference between the top companies and the bottom companies. So all the companies could remain profitable and could be making money, but these bottom companies just weren't competing at that high of a level. They're missing out on some efficiencies. So these activity ratios are what is going to measure how effective the company is, specifically against its peers. Now, the first one we're going to look at here in this subset called activity ratios is inventory turnover. So in this inventory turnover, right, we're going to be looking at cost of goods sold and inventory. So we're going to measure how active the inventory is, meaning how quickly is it moving from the company to the consumer? All right. So this is an activity. You make a product, you hold it in inventory, and then you sell it. So if you take the cost of goods sold, maybe that is, say, 10 million, and the inventory is 1 million, that's what we would say 10 turns. Think of it like this. You have an empty store, and you fill the store up with products, and by the end of the year, in 12 months, it's completely empty. The store is completely empty. That's 1 turn. that's not very efficient to buy everything you need for 1 year and have one turn. Probably be better if the store bought everything it needed for the week, and at the end of the week, everything was sold out and they replenish. So that'd be 52 inventory turns. Some companies strive to have over 300 inventory turns on their location. So you want to have really only a couple days worth of inventory on the shelf, and when that sells out, you want to restock only a couple days worth of inventory. You don't want to stock, months and months and months worth of inventory, but you have to be careful. You don't want to have a stock out situation where someone comes to you to buy a product, you don't have it, they go to their competitor. This can happen in simulation. So if you over-advertise and you generate demand for 1,000 more cars than you built, now those people are out there, you can't satisfy them, they're going to go to another competitor and get their excess cars if they over-manufactured or, so you got to be careful. You might create demand for your product, and then there's not enough, you don't have enough capacity, your customers are going to go somewhere else. I remember there used to be a chain of restaurants right next to each other. There were 3 restaurants, and I don't remember specifically what they were. Maybe we'll say like you had, maybe over here, by the mall, you got Cheesecake Factory, California Pizza Kitchen, and then there's P.F. Chang's, right? So at one point, everybody wanted to go to Cheesecake Factory. You go in there, and they're like, it's an hour and 45-minute wait. So you're like, I guess it's California Pizza Kitchen. You go there, 5 minutes wait. Okay, I'll wait. Or maybe you stop at Cheesecake Factory, hour and 45 minutes, P.F. Chang's, 45 minutes, and you settle for California Pizza Kitchen because there's no wait. So this is an issue where Cheesecake Factory is losing customers because they don't have the ability to seat everybody that wants to go there. And that's why eventually their restaurants evolved into such big restaurants to have such big seating, because they know that if you come there and there's a really long wait, you're going to go somewhere else, to a competitor. And maybe you like that competitor more and you never come back to Cheesecake Factory. So these are things that you want to look over. So companies definitely want to measure the inventory turns, and they want to turn the inventory much more frequently. Now, to do this, though, you have to have good operational activity, management skills, and discipline, because it's very easy to overstock. Less thinking is involved. Just stock more than we possibly use. We won't run out. So it's very difficult to accurately get a better idea of what the inventory should be. Now, this average age inventory is sort of a sub-formula where we can take the inventory turns, divide by 365, and we'll come into an average number of days of inventory on hand. So that way, if you're looking at, you go into a particular store, and then you see a huge amount of inventory on the shelf. Maybe it's a clothing store, and they have 500 winter jackets there. And you get an idea that they've definitely overstocked. So there are numbers to kind of calculate how many days on hand they have. And for a lot of companies, it may be a cutoff. Once they have 50 days on hand, they need to start looking into it or start evaluating why did that happen. Continuing with activity ratios, we have the average collection period, which is going to be accounts receivable divided by the average day sales. So this will tell us the amount, how many days it took to collect that money. So, for example, your accounts receivable is going to be a buildup of money people owe you. So in your accounts receivable, you may have people, maybe everybody in this room owes me money at different amounts for different lengths of time. So if I add up all the money that's owed to me, that would be my total accounts receivable. And if I divide by the average sales per day, I would get an idea of what my collection period is. So, if a company is selling $1,000 a day and they have $30,000 in accounts receivable, it takes an average of 30 days to collect. So, because think of it, you sell $1,000, didn't collect any money. You sell another $1,000, now you have $2,000 in sales, no money's been collected. So you get up to $30,000 of money sold, and and your average sales are $1,000 a day, then that's 30 days worth of accounts receivable sitting there. And to calculate, you could also do accounts receivable divided by annual sales divided by 365. So this average sales per day is really annual sales divided by 365 days a year to get the sales per day. And this again is giving us an idea of how quickly or efficiently are we collecting our accounts receivable. So companies that do a better job, my first job was in accounts receivable, so if a company is good at sizing up who they're lending money to, right? So if you have a bunch of friends, there might be some friends that you know not to lend money to because they don't pay you back. And other friends that will pay you back twice because they forget, and they insist that they need to pay you back. So you would have a ranking system who you would more likely want to lend money to and who you wouldn't. That's the same thing for companies. Then they have terms. They try to express, like, you need to pay me back in X amount of time. Just like you may have companies where you owe money to, and if you don't pay them back, they start to charge interest or late fees. So if you don't, the nastiest is the credit card companies. So of course they're charging interest, but if you don't pay them what they demand, now there's a late fee. So this encourages you to always pay your credit cards on time and not let them elapse. So these are different policies. They call it the 5 C's of collection to make sure that when you loan money out to other customers or other companies, that in exchange, basically what you're doing is you're selling them your product, but you're letting them pay you for it later. So there are some companies that have a better ability to pay you later if they have a better track record, they're more financially stable. So these are things that companies continue to enhance their collection. Lazy companies that do nothing about collecting their accounts receivable will have their accounts receivable grow quite quickly as companies take advantage of the fact that they don't really care how or when they get paid back. So that's why companies are a little bit more responsible about the accounts receivable, will have their accounts receivable collected faster. And that's what you want as a company. You want to collect that money for your sales as fast as possible. Okay, so as far as average collection periods, it differs between companies and industries. Some companies are more cash or credit card oriented. So if you have a retail store, a lot of your sales are going to be either in cash or in credit cards, which means your accounts receivable is going to be very small. Some businesses could be a defense company where you're selling defense parts to other defense companies, and you have to wait for them to sell their final product, so your collection times might be a lot longer in defense-oriented companies compared to retail-oriented companies. So it really depends on the industry it serves and the customers as far as getting averages of collection. So that's why you might see some stores are no credit cards, cash only. And that would be the most, a company with zero accounts receivable, because they're forcing all their sales to be in cash. Okay, now switching to payments. So accounts receivable are collecting money. Now we're switching to the other side, how long it takes us to pay back money we borrow as a corporation. So accounts payable divided by average purchases per day, and we get a calculation of what the average payment period is. So this is something that people who lend you, who are going to extend you credit, may look at your average payment period. So if you're a company that pays pretty consistently on 30 days, other companies will be more likely to lend favorable terms to you. So before I was hired at a company, I would always usually review their financial statements, and I like to work for companies that had a lot of cash flow, who had very little debt and a lot of cash laying around, because it made it very easy for them to stay in business and not go bankrupt. And it's also very easy if you're working in the accounts payable department, that this accounts payable department was their average payment period was less than 30 days, because it's basically a bill comes in, pay it. You know, it's sort of like you may have this set up where your accounts that you owe money on, credit card accounts, subscription accounts like Netflix or Spotify, you may set them to automatically pay themselves. So they could just automatically, when it's due, charge your credit card and pay them. And then when your credit card's due, charge your bank account and pay them. So if you have enough cash flow, you're not really worried about managing your cash flow. Whatever your bills are, if you have a decent balance in your checking account, it may be beneficial to set auto pay up on most of your bills so that way you never forget. And that would be similar to a company that has a very positive cash flow that can just pay their bills. But there are a lot of companies, like there are a lot of individuals, that have to manage when and how much they pay back their bills. So in order to make rent, you may have to skip your cable bill or your cell phone bill to make rent this month. So you might have to prioritize who gets paid back based on what the consequences are. So having them cut off your cable or your cell phone bill is preferable to being thrown out on the street. So this is where individuals as well as companies, they manage how and who and when they're going to pay bills back. So typically, I know in a business scenario, if there's going to be a charge or additional interest by being late on paying back, you're generally favored to pay those back. And in fact, to incentivize their customers to pay back even faster, there might be discounts. 210 net 30 is an accounting term where if you pay within 10 days, you get a 2% discount. So that encourages companies who can afford it that pay early to get that discount. Okay, so again, how quickly you pay your debts is a sign of how well your company's managed or how financially solvent your company is. Now, total asset turnover, this is the ratio in the simulation a lot of teams have a problem with. It's sales divided by total assets. So it's really taking your assets and seeing how much sales they can generate. So how efficient are your assets? So say your asset is a factory, and your factory, you want to look at your $10 million factory and see how many sales it generates. Now, if that factory is only running 8 hours a day and you have more demand, it used to be, okay, well, let's open up a second factory and run that for 8 hours a day. Until someone brilliant came along and said, well, listen, what happens after 5 p.m. to this factory? Oh, we just close it and then we wait till the next morning, people come in at 9 and we start up again. Well, why don't you run a second shift on that factory? Or why don't you run a third shift? So you run 24 hours a day, keep that factory running 24 hours a day. You don't have to build two new factories. You could use one factory, and it's a lot more efficient as far as asset turnover by running that factory all day long. You may notice that some businesses, maybe you're a Starbucks location, right? So a lot of your business is in the morning, but they know that they have this asset open in the afternoon and at night, so to make sure that business is still humming, they'll offer, they'll have happy hour, 2-for-1 Starbucks lattes after 2 p.m. Dunkin' Donuts does something similar because they're trying to encourage business throughout the day, not at their peak capacity. So if you're going to have that asset open, how can we keep this store busy all day long? It's something that McDonald's solved by adding breakfast. So it used to be McDonald's was just hamburgers, milkshakes, and fries. Typically lunch, maybe dinner food. They added breakfast. Now McDonald's is able to extend all those restaurants for an extra amount of hours. And in some cases, some McDonald's are 24 hours a day. And breakfast is moved from just a 4-hour window to a 24-hour window. To, you have this demand, why not utilize the asset as much as possible? It's sort of like, that's why your cars are bad assets, because you have a car, you're only using it an hour a day. It'd be much better if you had that car, you use it for the hour you need it and rent out the 23 hours to somebody else. So the car becomes an asset that generates. That's why most homes are bad assets, because you're only using a fraction of the space. You're spending most of your time in maybe 2 rooms of a 9-room house. So that's why renting out other rooms in the house might make that asset more effective. Last example, if you have and I see some students in the simulation do this, they buy factories they don't need. So they might buy, instead they only need 1 new factory, but they buy 5. So now they pumped up their assets by example, maybe 100 million. So the assets are up 100 million. Sales are not going to go up as fast as these assets because these other 4 factories are not generating any cars that are going to be sold. So you're just bloating up assets with no sales attached to them. So that's why as a business, you don't expand the business until there's demand to expand the business. So if you have, this company Shake Shack started as a small hot dog vendor in a park in New York City as just a cart. And as it became more popular, it got bigger and bigger, became a restaurant, got bigger and bigger, became a chain of restaurants, of locations. So that's, their assets are turning over a lot better now. They got bigger assets as the demand for the product increased. So you always want to try to keep your sales in line with the size of your assets. So for example, a grocery store business, they usually have a pretty rapid turnover of assets because of a lot of their inventory is going to spoil. They want to sell that pretty quickly. So when you have your baked goods, your dairy products, things that are going to spoil, you want to make sure that they're selling fast, or you're not ordering too much, because you don't want that to go in the garbage. In grocery stores, when they get very large, they can hold a lot more assets. So if you're not going to be in a highly populated area, you're not going to see big size grocery stores like you do, say, in this area. And also, it's interesting because most American grocery shopping is once a week, where other parts of the world it's once a day. So that also comes in the factor of how much you're going to hold, how quickly you're going to sell your assets. So the industries, that's why it can sometimes be confusing, expiration dates, sell-by dates. Grocery stores want to keep track of this, and what they really hate are the people who come into the grocery store and look for the freshest loaf of bread or the freshest eggs, sometimes pulling out things of milk cartons, putting them on the floor to get the freshest milk carton in the back. This is something that grocery stores really hate because they want you to buy the things that are going to expire sooner than later, so they keep that rotation. So sometimes in the way a lot of those, if you ever go into a lot of stores, they stock from behind, so the new stuff goes in back, the old stuff gets pushed forward, and they may even have racks where you can't easily get the thing behind it without disrupting the whole rack. So the financial leverage is looking at, these debt ratios are looking at how you're leveraging up money in the company and how much debt a company is going to have. Now, when we're talking about these financial ratios, what we're looking at in leverage is really, think of like a lever. And you can't move that rock with a small stick, but if you have a really big stick, it's much easier to move that rock. You have more leverage. So in a business, think of it this way. You have $10 million, and you have two choices. You could open up one location for $10 million, have it completely paid off, pay for it all in cash, open up one location. And for that location is going to make $1 million of profit a year. Okay? Or you can take that $10 million as collateral, borrow another $90 million, so now you have $100 million, and open up 10 locations. So you're bringing $10 million of your own money and borrowing $90 million. So your debt level is 90%. Your company's 90% financed by debt, 10% by cash or equity. But you're opening up 10 locations, not one, so you're not bringing in $1 million of profit a year, you're bringing in $10 million. So if your interest charges are, say, $1 million, that makes sense because now, instead of making $1 million a year, you're going to make $9 million a year once you subtract out the interest for borrowing that money. So companies who can accurately utilize their leverage, if you're someone like Chipotle Mexican Grill, and you know that if I don't get my restaurants built and out there, competitors like Carbo Fresh are going to come in, copy my idea, and fill my spot in the market. So I want to get this idea built and out to as many locations as possible before a similar competitor arises. So in this case, it makes sense for me to leverage myself to expand as quickly as possible. By the way, Chipotle Mexican Grill expanded mostly on equity, not debt. So the degrees of indebtedness is what we're looking at. How much debt is a company taking on? And this is critical because the more debt, the riskier the business. If you own one location and is fully paid off, there's not that much risk in that business. But if you have 10 locations and 90% is financed by debt and there's a recession and sales and profits go down, Now there's a risk you could be foreclosed on. You know, it's sort of like, just think of if you owned a house that was fully paid off, it seemed a lot less risky than buying a house that's 5% down. You know, but sometimes leverage is the only way to get that house, and you'll grow into it. So to get where you need to go, usually companies need leverage early on to get there. Okay, we'll continue next class with a closer examination of the debt ratios.